Good afternoon, everyone, and thank you for joining us this afternoon. My name is Carmel Haynes, and I'm the Executive Director of BIBA. On behalf of Invest Barbados and BIBA, we are delighted to have you join us today for a dialogue on the global minimum corporate tax rate and Barbados. We know since May, when things started to accelerate, thanks to the US endorsing the idea of a global minimum tax rate, things seem to be developing and happening very quickly. So we're very pleased and honored that we've got representatives from the government of Barbados, both officials and advisors, to come give a perspective today on how Barbados intends to grapple with this new dispensation. So without further ado, I'd like to introduce our president, Mr. Derek Cummins, who is the president of BIBA and also the CEO of Micor Bank and Trust. Derek, over to you.
Thank you, Carmel. We have a packed agenda today for a short period, so I won't be long. Just want to welcome everyone to today's webinar. Looking forward for a meaningful discourse. I would like to say that Barbados for many decades have done two things. One, we have lobbied, encouraged, agitated, compelled the so-called first world to even the playing field, to recognize and adapt policies fit for our inherent characteristics and challenges, and to see us as a force, and also to honor our sovereignty. We have always simultaneously worked at self-determination. This is determining our destiny, both things simultaneously. This present situation is no different. We can and shall, as we must, give light to the neo-colonial treatment that is being meted out and to the continued infringement on our sovereignty and on our sovereign right to establish internal policy. Simultaneously, though, we are here bringing our minds and hearts together to conceive, then design and implement strategies that will shape the future of Barbados for generations to come. It is critical that we do them both. Our speakers today have much to say on where we are, what we have done today, and what are our next steps. We are also very keen on hearing from you. So I take great pleasure now in handing over to Renata for those introductions.
Thank you very much, Carmel, and thank you, Derek. And thanks to all for joining us today, an unprecedented number of stakeholders. Very much a clear indication of the interest of the Barbados position and the desire to better appreciate the impact of this proposal and our national response to same. We therefore look forward to hearing from our three speakers, all of whom I'm sure you are familiar with. Their individual and collective accomplishments are many, but for today's purpose, and by way of introduction and reminder, Kevin Hunte is appointed coordinator of our Global Business Review Taskforce. For the past 4 years, Kevin has served as Director of International Business, Ministry of International Business and Industry. An attorney at law by profession, Kevin will today share government's perspective. Professor Avinash Persaud is a special envoy to the Prime Minister of Barbados, the Honorable Mia Mottley, on investment and financial services. His distinguished career spans finance, public policy, and academia. Today, we look to Professor Persaud to offer global context and to expound on the policy adopted. Ben Arrindell is a special advisor and envoy to the government of Barbados. Throughout his career, he has provided international tax services to global clients, including many major multinational companies and high net worth individuals, simultaneously making a significant contribution to new and existing legislation in Barbados. I could go on, but today he brings to this dialogue a taxation perspective. On behalf of BIBA, the team at Invest Barbados, and all gathered here today, I thank all three for the clarity they are about to provide, the time taken to provide us with an update, and their availability to take questions after the three perspectives have been shared. I thank you, and I pass over to Kevin to get the ball rolling. Kevin?
Good afternoon, and thank you very much, Renata. Good afternoon to my colleagues, Professor Persaud and Special Envoy, Mr. Arrindell, and good afternoon to Derek and Carmel and Grace as well. Good afternoon to, I see we have 280 attendees, and good afternoon to each and every one of you here. I am going to be extremely brief, but I'm just going to give a statement as it relates to basically what transpired within the last few weeks and government's position. As you all know, Barbados is a member of the IF, and that stands for the Inclusive Framework, which is an organization under the umbrella of the OECD. The Inclusive Framework has specific responsibility for various aspects of the BEPS program, but in particular, we're speaking of Action 1, which pertains to the digital economy and the taxation of the digital economy. As Carmel would have indicated in her opening statement, this issue gained momentum with the advent of the Biden administration coming to power. And what transpired before the July 1st meeting was that Barbados was contacted by the OECD relative to whether we accepted the position that was being put forward in what is known as a consensus statement. It is not an agreement that has been signed by any country, by any of the 138, I believe, members of the Inclusive Framework, but is known as a consensus statement whereby it reflects which countries are in agreement with moving forward with the policies stated therein. At that point in time, Barbados indicated that we had, while we were committed and we remain committed to good tax policy, good governance, and international standards, we had some challenges with the consensus as it was presented to us then in the form of building blocks relative to Pillars 1 and Pillar 2. The main challenges that we had was, of course, whether there was adequate substance carve-out or an adequate carve-out for the economic substance regime which Barbados has in place, because we are a low or nominal tax jurisdiction. The second challenge that we had was in relation to the implementation timeframe, where it is expected that the elements of these pillars would be enacted in our legislation in 2022 and come into force in 2023. And then the third challenge that we had was the setting of the floor as opposed to the ceiling, where the terminology relative to the corporate minimum tax rate is deemed to be at least, I'm quoting, at least 15%. We indicated at the time that while we were committed, but we had challenges with those three areas. And what came back to us was that since we could not, at that time, we had not done or we not had the opportunity of full free discourse among the political directorate at that time, or further research to weigh the economic impact, if any, that this may have. And so we would have raised those issues along with all the other well-known circumstances relative to our economic situation in Barbados, relative to dealing with COVID, etc. What was communicated to us was that because we, at that point in time, could not give an outright acceptance of the phrase at least 15%, we were deemed then to be not in consensus. And that is why we were slated or listed with the 8 countries that did not form or join the consensus. On the July 1st meeting, we did make it clear what our position was. And we then would have continued to engage with the OECD. What I can tell you is that subsequent to that, we would have received correspondence, as all other Inclusive Framework members, indicating that between now and the October meeting, there will be robust discussion, dialogue to look to finalize those areas that we had concern about, primarily though the economic substance carve-out, which is being developed on a formulaic basis, as well as exactly what the corporate minimum tax rate would be, among some other issues. We took the decision from a policy perspective that the seemingly bad press was not doing us any good. And it was also better that we articulate our position from within, from inside, working along with other countries who shared similar concerns. And I want to tell you that there are other countries that share concerns that are similar to ours. And so we took the decision then that we would communicate to the OECD that we would be joining the consensus statement. However, the issues that we have still remain outstanding. And we wanted to make sure that we engage with you and let you know that first, prior to you hearing that being or reading that being published on any OECD website. So where do we go from here? There are a series of meetings of different working parties and groups scheduled between now and the October meeting with a view to working out the kinks and the details of various unsettled elements of Pillars 1 and Pillar 2. And Barbados intends to participate as robustly and as fully as possible and make sure that the concerns that we have are addressed as far as they can be addressed, given the fact that we are playing on an international field. However, we have also begun our own local work in terms of not just responding to this, looking to see how it can affect the companies that would be impacted, particularly by Pillar 2, but looking to see how we can reposition and redesign the international business sector for a few years going forward. And so I will pause here and hand over either to Renata or to Professor Persaud, who I believe is the next speaker. Thank you.
Renata, would you like me to go ahead?
Yes, please, sir.
Great, thank you very much, and good afternoon, everyone. Let me thank BIBA and Invest Barbados for putting this together, a very important forum. We may well need to have repeats of this session over the next few months, and we're very much open to that. I can imagine that when you first heard the news of a potential global agreement announced at the G7 meeting for a minimum global tax, that you probably all felt quite frustrated, a little bit annoyed and angered at this continuing international movement. Earlier, people were expressing annoyance and anger at the issues of sovereignty. I think that the first thing to say is to provide some reassurance that we're not being completely blindsided about this. This is something, as Kevin said, we are members of the inclusive framework. So we have been observing very closely. We have been trying to look at all of the potential issues and developing our policy responses. And we have quite a few, which gives us some confidence. I think there are three main things to kick off with, and then hopefully after Ben said some words, we would open ourselves up to your questions. The first thing to say is, as a veterans of this saga, and it really is a saga, issues of global tax, there have been more twists and turns and games of thrones, and it keeps on happening. So the first thing to say is that this is significant. There will be those amongst you who will feel they could never agree, they could never reach a global agreement on a minimum tax. And if you look back at the history of these issues, they have tended to come together when the US has backed the initiative. And so we take this very seriously because the US position is now solidly behind this initiative. Indeed, it is being led by the US administration and by the US Treasury Secretary, Janet Yellen. And so I think you have to believe that the probability of this happening is probably 50%, maybe more, maybe less. Wherever it is precisely, it is higher than any number which says that you don't need to worry about this. So you need to worry about this. This is a high, there's a strong likelihood behind it, but it is by no means 100%. My view is it's probably 50-50, but it's significant enough that you need to plan for it, and we're certainly planning for it. The second thing to say is there's no point being in opposition. There's no point being seen as being outside of this. What benefit do we get from being outside of it? And we've all seen with whether it is these lists they put us on, that being outside causes much problems, that people don't want to be in our jurisdiction if we're on some list as an uncooperative member. So if it doesn't move ahead and we're outside, we've gained nothing, we've lost nothing. If it does move ahead and we're seen to be outside, we will lose something. We'll be seen and painted as being foot dragging in a non-cooperative jurisdiction, and it will create issues for us. So it was always our view that we would be moving along with the consensus. As Kevin said, the initial response, for which we were given just a few days to decide, and not enough time for there to be a proper debate, consultation, even a discussion in Parliament. Parliament is our sovereign decision making. No time for that. We were asked to make a decision, and as Kevin said, a technical response was sent by the team, which said asking various questions and expressing some concerns about a number of things. They view that as opposition. The signal very loudly and clearly being sent is that there's really no space and no room to be outside of this. Better to be on the inside, working to reform it, to improve it, to refine it. The third thing I would say is that fundamentally, we're actually not in a bad place, because fundamentally, they want to raise our taxes. So raising our taxes, which could mean more revenues if people stayed, increases our resources to try and keep people to stay. Imagine if it was the other way around. If fundamentally we're being forced to lower our taxes and have less revenues. Now we know that if we're out there at 15%, we will lose our international business. But what I'm saying is that fundamentally, this may well lead to additional resources that we can use to keep people, and I'll explain that in a moment. So our approach is to look to see how we can make this work. And let me, before I talk about the two ways in which we're looking at that, I know many of you are going to be angry about sovereignty, the issue of sovereignty. And let me be a little bit clear, because they are not telling us what our corporate tax rates should be. I mean, they're effectively telling us, but they're not telling us, if you see what I mean. So they're saying you can have your tax rates at 1% to 5% if you want, no problem. It's just that when those companies have their other entities are selling in Europe, they're going to take the revenues they get in Europe and they're going to tax them as if you were paying 15% in your Barbados entity. So in other words, there will be no benefit for that company. The company would pay, say, 1% tax to Barbados, but be paying the difference, 14%, up based on their sales in Europe or their sales in America or their sales elsewhere. So effectively, they're going to force a tax rate of 15. You could have a tax rate of 1, they're saying, but we're going to take the rest of those revenues if those companies are operating in our countries and selling to our consumers. And of course, what they're really focused on here is Google and Facebook and those other companies that basically put their production in low tax environments and sell to their countries. I think the best argument against this is actually not an argument of sovereignty. It's not an argument that we must be free to do whatever we want to do, because that will be viewed as being not good social citizens. The best argument is this anti-development. Developing countries are producers. Rich countries are consumers. They're saying taxes should be based on where the consumption is. That doesn't make sense. Anyway, what is our approach? Twofold. Firstly, inside the tent, we're going to argue and agitate for a substance carve-out. This is what we've been spending the past decade or so developing, this issue of substance. And if you're doing real substance in our country, the tax rate that we impose upon you is the tax rate you have and nothing extra. As Kevin said, we think there is a support on that. Janet Yellen is not a big fan of that. Maybe her views will change. But we have to have a plan B, because it's not at all clear that plan A and substance, which is basically where we are today. So our first plan will be to argue where we are today, that there's a substance carve out, but we need a plan B. And we've been looking at a number of options. I will not want to tell you that we have a clear option. It has to be discussed and consulted, and we're keen on your ideas. Now, whatever the plan B is, it can't be a tax exemption or a direct tax concession, because they will wrap that all up together and say your tax rate is lower. It has to be something in parallel. And we discussed a couple of these options, in fact, with OECD and others. Here's one example. And I hope that giving you this example is not to tell you that this is what we're going to do, but it's an example of what could be done, and an example of what could be done, and an example that hopefully will encourage you to come up with some ideas of your own, which you can help us with. But let us say that the global tax rate is 15%. People would pay 15%. But we would say to people that if, for example, you are spending money in Barbados on research and development, that we might give you a grant on research and development. That grant will then mean that if you added your grant together with your taxes that you've actually paid, that indeed you've ended up at a competitive rate. And it'll be a function of it being spent on research and development, the initial amount of money being spent in our country, but that grant can be spent on R&D wherever you are. I'm offering you that as one example of what we can do. Only possible for us to do that because we're starting off from a point where our rates are lower than the 15%, as opposed to many developed countries where their rates are higher. Let me conclude my remarks then. So we have become quite resilient to the perpetual movement of goalposts. Yes, I know how frustrating and angry it is. There is no point, however, being a vocally opposed to this. We need to work within the camp to get a better system, and that's what our plan is. And you may see an announcement on that early or later. It's not clear to me exactly when, but do not be surprised by that. We will work within the consensus to make it better. Our principal focus is on the substance carve out, because that actually leads our people exactly where you are today, that where there's substance in our country, our tax rates apply. But we're also looking at plan Bs if the substance carve out is either not adequate or is removed. And those plan Bs, I think there are opportunities for that, because we're coming from a point in which fundamentally we would be raising our taxes rather than lower them. So we can think of revenue neutral or revenue positive ways in which we can remain highly competitive. And in fact, playing their game. And the reason why this is anti-development is because we know the location of companies is not just about their taxes. Alabama got Mercedes to move from Stuttgart to Alabama. How? By offering them $280 million worth of grants. Sunderland is keeping Nissan in Sunderland after Brexit. How? Because of 145 million pounds of incentives. We at the moment don't have those things. And that's why it's fundamentally an unfair approach. It's anti-development. But if what they're asking us to do is raise our taxes, it creates resources that we can then turn around and use to keep people here and to make it competitive. Thank you, and I'm very keen to hear your questions and thoughts and concerns. After Ben has spoken, we're happy to spend some time on that, either both today and in future, as much as you like.
Thank you. Thank you very much, Professor Persaud, for sharing your thoughts and offering us some perspectives. If anyone who's on the call has any questions or comments, feel free to place those in the Q&A segment. Of course, we have catered to this being a dialogue. And as such, once Mr. Arrindell has presented his own thoughts, feel free to add your own questions and comments. Mr. Arrindell?
Thank you, Renata. Good afternoon, everyone. I'm going to be fairly brief. I just really want to set the scene in terms of the possible impact of the Pillar 2 rules, because we've determined that the Pillar 1 rules really do not impact us in any significant way. So we focused on the Pillar 2 rules. The first thing I think you have to recognize is that the design of the Pillar 2 rules is really meant to apply to multinational enterprises. That is where you have companies operating in different jurisdictions, two or more jurisdictions, and where the global revenues of that multinational group is at least 750 million euros, which I think is about 900 million US dollars. So it will apply to only those entities that meet that threshold. However, there is a twist because the rules also allow countries individually to determine that they can apply those rules to multinationals that do not necessarily meet that threshold. So that's one area of uncertainty, because some countries may decide that the threshold they're going to use is, let's say, 600 million euros. So I would say that from a practical perspective, sometimes it might be difficult to determine whether a particular multinational will be covered or not. So that's the threshold. And so therefore, in the context of Barbados, we have many companies that operate in different jurisdictions, particularly our Canadian-based companies, where the parent company is in Canada. But they will not necessarily meet that 750 million euros, because we have quite a number of entrepreneurial companies that are not that large. So those will not be impacted by those rules. However, the multinationals that we have will be. And I can think, for example, of the US multinationals that have set up hybrid companies in Barbados to finance their operations in the UK, for example, where they will definitely be above that threshold and will be impacted by these rules. And we know that we generate a significant amount of revenue, tax revenue, from those entities. So finding a solution to this issue is going to be critical for those multinationals that operate in Barbados. And there are three main elements to the Pillar 2 rules. The first is the income inclusion rule, which Avinash talked about, where if I give an example, you have a multinational operating in Barbados, where they meet the threshold, they are paying tax, let's say at an effective tax rate of 2%, and the global minimum rate is set at 15%. So in that situation, that multinational, the operation in Barbados, its profits will be taxed in the country of residence of the parent, to the extent that the global minimum rate is 15%, and they're only paying an effective rate of 2%. So there'll be a 13% top-up tax on the profits of that entity, irrespective of whether those profits are distributed to the parent company or not. So in a sense, it's a little bit like the control foreign company rules, where it goes a little bit further than that. When the Barbados company makes a distribution to the parent company, then there will be a credit given for the 2% tax that was paid in Barbados and the 13% top-up tax that was paid in the hands of the parent company. However, what it does mean is that those countries that decided to apply these rules will ensure that there is a minimum tax of 15% paid on the profits of the Barbados company, whether those profits are distributed or not. So that's the first rule. The second rule is that there will be an under-taxed payments rule, whereby, and this is very similar to the rules that currently apply in places like the UK, what that we call the anti-hybrid rules, except that these rules will apply to deny a deduction to payments made to a related party in a jurisdiction where the payments that are made are not taxed at the minimum tax rate of 15%. So, for example, if you had a UK company making payments to an affiliated company in Barbados, where that related company is being taxed at 2%, the pair will be denied a deduction. There are some additional complications, which I won't go into, but essentially, the pair will be denied a deduction for those payments. Then there is the third rule is the subject to tax rule, which is really a treaty-based rule. And again, I will give you an example. If we have a Barbados company which is receiving interest payments from the UK, currently the Barbados-UK treaty says those interest payments will be subject to a zero withholding tax. However, under the subject to tax rule, this will apply irrespective of what the treaty says, to say that to the extent that the Barbados company in receipt of these interest payments is taxed at a rate below the 15%. So in this case, let's say an effective tax rate of 2%, that there will be a subject to tax rule applied, and those payments, interest payments, will be subject to a tax of at least 7.5 to 9% in the UK. So we've always said that this essentially is a rule that overrides the tax treaties that Barbados have in place. We currently have, excluding CARICOM, I think we have something like about 30 or 29 treaties with other countries. So the OECD, on the other hand, have said that there won't be a treaty override. And I'm assuming that what will happen is that there will be a multilateral convention which will allow countries to be able to apply these rules irrespective of what a particular treaty says. I mean, those are essentially the design rules. They have suggested a carve-out, and the carve-out at the moment is based on the company's assets and its payroll. It will only be a 5% of the profits of the company that would be allowed to be carved out. So that 95% of it will be subject to the income inclusion rule. Our starting point was that given that we have gone to a significant amount of trouble to introduce economic substance legislation because of the OECD's BEPS initiative, and because of the fact that we are a low tax jurisdiction, that once a company meets our economic substance test, then their profits should be carved out from the income inclusion rule. However, I mean, that was an optimistic position. We knew that that was not going to fly with the OECD. But we are disappointed with the level of carve-out that has been proposed at the moment. So one of the things that we will be doing will be, as part of Kevin's task force, we'll be reaching out to other jurisdictions that have similar concerns to ours, to try to come up with a common position in respect of an economic substance carve-out that more meets our needs and is very different to the one that's proposed currently. I think I will stop there, and I mean, I'm happy to answer more detailed questions if people want to know more about the rules, but I'll stop there to allow time for discussion and questions.
Well, thank you very much, Ben, and then of course, Avi and Kevin, for having taken us through and setting up to let us understand just exactly where we stand right now. I know there's a little bit of uncertainty, and questions have already started to come in the chat. Anyone who wants to ask a question, please post it in either the question and answer or the chat dialogue box. So let me start off with this first question. Lower rates are supposed to be an incentive for companies to substantively locate here. If there's no longer an advantage, companies don't have to come here. Is the race then to be how much in grants and the like we can be competitive in giving away? And what of the number and significance of those countries not interested in this global minimum? No negotiating clout there. This is pretty much, I think, open. I don't know.
Well, I mean, I think the reality, Carmel, is that companies, multinational companies, sell to the rich countries. So yes, so it's going to be very hard to be avoiding this, because you basically it will be a company that's able to avoid this is a company that does not have sales in the largest countries in the world. And, you know, if you're China or India, you probably quite like this idea too, because Facebook and China, Facebook tells you it has 2 billion users, right? About half of those are actually in China and India. They're not in America. They're not in Europe. So China and India are probably quite happy with this idea as well, because they're going to be big consumers. So if you start knocking off you can't be a company that sells in the US, you can't be a company that sells in Europe, can't be a company that sells in China and India. I don't think there is much space really left. So we need to find, I mean, certainly, look, I'm not to say to close off that possibility, but we need to find alternatives. And I think it may well be, I mean, today the world competes on grants. The rich countries competes on grants. People have heard me say before, no new car manufacturing plant in the world has established anywhere without massive grants. And we've not played that game before because we didn't have the revenues for that. But a tax rate going from 1 to 15 may well provide us with the resources that allows us to provide the grants that makes us competitive. That would be part of the plan B if we can't win a broader substance carve out.
Okay, thanks, Avi. And then, sorry, Professor Persaud, and there was another question. Yeah, thanks, Avi. This initiative of minimum tax, will it also apply to European countries considered tax havens?
Yeah, the answer to that is yes, it would be, but just note that the European construct is a little different. And so while you have individual countries in the European bloc, there's still the procedure for it to be adopted by the European Parliament, which requires all EU countries to be in agreement. But yes, it will be applicable to those European countries considered tax havens.
And I should add to that, there's some moves afoot to try and exclude certain types of activities. If they make further progress on that, the kinds of activities that they're looking at would be things like financial services, Luxembourg, Dublin, and London. And of course, that would be of benefit to ourselves as well. But at the moment, that's not the case.
So
Yeah,
another. Sorry,
I
Ben.
think
Sorry,
continue. Just to add to that, Avi, I mean, the point is that the financial services carve out is really only meant to apply stage to pillar 1, yeah, but not to pillar 2. And there's no move afoot at the moment to support exclusion of financial services from pillar 2, unfortunately.
Okay, so I guess in the same context, we have a question. For over 35 years, tax planning has been a major driver for the international business sector. And we have known for over 35 years that this would be a constant challenge to the industry. We have, in effect, had 35 years to position ourselves as the premier facilitator and provider of professional, civil, and regulatory services to the international business sector in this region and beyond, such that tax advantages are not the only benefit that can be offered. Does the panel believe that we are anywhere near such a goal? Recent experiences in company reorganization in Barbados would indicate that we are not. So that's
well. Look, we've always tried. We've always tried to be. I mean, that's not exactly a new point. We've always known that there needs to be multiple ways of attracting people, and it could not always be tax, because that will be a race to the bottom. But I would say that what we've all been pleasantly surprised by is the success of the 12-month stamp for business people. And it really has opened up the possibility of us being a lifestyle location place for the kinds of businesses, the new businesses in the world, which are being driven by people and where the people are, rather than by where the factory is or where things are being sold, where professional people want to locate themselves. And that's because of a range of things that make us an attractive place to live. The sophistication of our restaurant scene, the ease of our beaches, etc. So those are things we need to continue to invest in to be a good lifestyle location place. I wouldn't want to speak for our lawyers and accountants. Ben and others can speak for them, but I would say that our professional service standards are high. They're competitive, but to say that people would come here just for that, we're clearly not there yet. We have to continue to develop that.
And on that note, I would also add then that this is where we are now, where we have to, as it were, take the bull by the horns and look to see how we would redevelop and reposition the sector. Clearly not being able to rely on a low corporate tax rate as our only selling point. And I'll take the opportunity here, Carmel and panel, if you don't mind, to just throw out to our attendees the fact that part of the work that we're doing involves just that, but we want your input, we want your thoughts, we want your ideas, and we're working in conjunction with Invest Barbados. And so if you would submit any ideas you have, whether in terms of new products or whether a revamp of existing products or any idea at all, if you can email it to productdevelopment@investbarbados.org, productdevelopment@investbarbados.org. And if you can get them into us, say 2 Mondays from now, August 23rd, I believe it is, we would appreciate it. Thank you.
Thanks, Kevin.
But I do want to add something, because, sorry, Ben, you go ahead. But I want to say something a bit about how businesses plan for this environment. But Ben, you go ahead.
Okay. And the point I was going to make is, and I think that's what the speaker was getting at to some extent, that we have relied heavily on a low tax rate. We have allowed inefficiencies to creep into our system, where the frictional cost of doing business is in Barbados is too high. And that I think is something that we are going to have to address. I mean, it's something we've talked about for many, many years. But I think at this point in time is where the rubber hits the road, and we really have to do something about it. And I think, Avi, the free zone proposal is one way of approaching this, where we can really have systems in place that will compete with the best in the world. And the the trick then is to ensure that we roll that out into the rest of the rest of the business, for the benefit of the rest of the business community.
So I think, because I don't want the business community is going to be understandably unnerved, unsettled. And so I want to make sure that we're clear on a few things. Firstly, there is no getting around the fact that we need to be a more efficient jurisdiction. And that is why there's been, even before this 15% tax, all this investment in improving doing business. If any of you, like me, have recently had to become a director and had to get a police certificate of good character, something that used to have to get up at 5 a.m. in the morning and queue up for 2 hours, I actually went online and got it in 15 minutes. We're doing the same, we're rolling that out for driving license, for passports, all of those things. We just have to do that. To us, it's a shock, but it makes us competitive because that's where the world is. But look, I don't want people to think that this is a very unsettled ground and how do I plan for this future? We need to continue investing to improve the quality of everything we do, of our service, of our technical capacity, and we have the capacity to respond because we're not at a 30% rate being forced to go down to 15 and losing revenues. We're at a 1 to 5.5% rate. We may have to go to 15, which will create revenues that we can use to make ourselves competitive. Because people would not stay here if all we did was move to a 15% rate. So I don't want people to think that they need to start looking abroad because we don't know where Barbados is going to be. We are in a position here where we can respond. We'd love your ideas, but we are in a good position to respond. And we're looking at some interesting ideas. We could become an R&D center if we can find a way of giving grants that incentivizes them to spend a bit more money of R&D in Barbados.
Okay, thanks.
I think also one of the I think also one of the keys is that we have to ensure that there is a level playing field. If you're looking at Europe, for example, if you look at Malta, the system they have in Malta, which is like a 30% tax rate, but when the company pays a dividend, there is a tax credit given to the shareholder, which essentially reduces the effective tax rate paid on those profits to a very low amount, say 4% or whatever. Now, if you're looking at what is the effective tax rate of the Malta company, it is 30%. Because of the way you arrive at calculating the effective tax rate. So clearly, if that position was allowed to remain, and then there'll be a lot of companies that will be looking to move from other jurisdictions, such as Barbados and similar jurisdictions to ours, to Malta. So I think the key is we have to ensure that the way that the effective tax rate is calculated creates a level playing field.
Okay, thanks, Ben. I just wanted to once again go back to the chats, the questions. So someone asked, and Avi, I think you indirectly answered this question. Would Barbados consider implementing a mechanism for those that meet the euro 750 million threshold to top up to that 15%? Example, like an alternative minimum tax. And if not, why not? Why would Barbados leave that additional tax on the table to be taken by the entity's headquarter country? But I believe, Abby, you're saying that still on the table. We wouldn't. Right.
That would be silly. We wouldn't, and we would find a way of doing it in a way that keeps us globally competitive, which I think means using that to fund grants, but grants that are awarded on the basis of doing something that's useful, like R&D or something else.
Yeah, and part of the focus of the task force that Kevin will be chairing will be to look at all options. So we won't be ignoring any options without fully discussing them and getting your views on them and coming up with with a plan that will work for us. So nothing's off the table.
Okay, great. So in that order, I like one of the questions is I like the idea Avi proposed about providing incentives or grants which come from the additional tax revenues. What about linking incentives to employment of Barbadians and CARICOM citizens, which would bolster with employment and knowledge transfer? The companies would benefit from reduced labor costs and potentially increased productivity, which may even cause said companies to put more business through its Barbados subsidiary.
Well, we're a small island, and it's not at all clear that employing more people would increase their average productivity or lower their average labor costs, to be frank. And nor do we want to be a low-cost place for workers. We want well-paid professionals. But so I think I think employment could be one factor, but we need other things. I think if we're thinking about Barbados for the future, we need to be a pole of knowledge, a creator of knowledge that exports knowledge to the world. And so the more we could use this as a silver lining in this cloud. Maybe we use this to generate hundreds of millions of dollars to invest in R&D, which is employing local people. So you get the grant if you've employed local people and doing R&D and spending money on R&D. That may be the way in which we could also let this initiative pave our future.
Okay.
And Avi, I mean, at the end of the day, in order for the grant system to work, that is exactly what we need. It can't be just based on number of employees. It has to be based on expenditure. And the greatest expenditure you have right now is on R&D. So the more of those companies that we can encourage to move to Barbados and spend lots of money in R&D, you can tie the grants to those. I mean, that's what Switzerland does. I suppose the issue, though, Avi, is that it will take time for that to happen. So what we need to do in the meantime is to try to make sure that we preserve the multinationals that we currently have to the extent we possibly can, while it takes time for the rest of it to develop.
Well, my idea is based around an idea that Ben Arrindell once gave to me a couple of years ago, where he was describing something totally different. Totally different. He was calling it a super allowance, that basically you spend a dollar. Yeah, you spend $1 and you got back $1.50, right? So we're saying to people that you spend $1 on R&D in Barbados and you may get back $10 to spend on R&D.
Correct.
But the point is that they're spending that first dollar, which we never had before, and we're giving them back the $10 that they gave us in tax. So it's a revenue neutral or revenue positive, plus we get substantial investment in R&D. And it's not a gimmick, it's substance. They're actually going to be doing something real.
Yeah.
Okay, so just to let everyone know, even though we had a 3 o'clock cutoff time, the questions are coming fast and furious. So we are going to extend, to the ability of the panelists to still remain and answer your questions, but we are not going to stop at 3 o'clock. So just Avi and Ben, on this same topic, how can we be sure that the incentives that you're proposing to offer from the increased revenue from the 15% minimum tax rate are not going to be seen as an attempt to lower the effective rate and still tax the relevant company for the difference?
We actually asked Pascal this very question, because it arose when we were pushing him on the anti-development aspect of this idea. And pointing out that the Switzerlands of this world will charge one rate, but give you large grants. And they were of the view, the key thing would be that they have to pay. And this is the point that Ben was also making on how we define what that tax rate is. But from a OECD perspective, is they have to have handed over, if you like, the 15%. If they can deduct something beforehand, then they will view that as not your tax rate. Right. So they hand over the 15%. then on a separate basis, because they have spent X millions on R&D in Barbados, they are due a grant. And the grant can be capped, so at no point are they ever getting back more than they've actually paid in their tax. So I think that will be the way in which it will be treated. And indeed, what we'll be doing, because remember, as we've said so many times before, the three of us, this is a game. And what we're doing now is playing their game. This is the game they play. We're not playing a different game, not playing a unique game. We're playing the Alabama game. We're playing the Sunderland game, which is we attract business by grants.
Yeah, and I think the only issue here would be for those companies that are exporting goods, for example, to ensure that we abide by the WTO rules. And we will do that because it will be based on employment and capital employed and expenditure and so on, as opposed to export. So that's fine. We just have to make sure that we design it in such a way that we WTO rules with respect to the export of goods. In respect of everything else, of course, as Avi says, I mean, it's from a tax perspective, the OECD at this point in time are not concerned if you give grants. I think the only concern would be that the EU may well take issue if your grants are excessive, because they may treat that as being anti-competitive vis-a-vis versus the EU. However, and I'm told that there are some proposed rules in the EU to apply their own internal rules to third countries. However, the thresholds are so high that we're not going to be impacted by that. They're really only concerned about the grants granted by China, for example. So the thresholds are so high, we would not be impacted by that.
Okay, thanks, Ben and Abby. Kevin, I know you responded earlier to the question regarding European jurisdictions. The question now is, will the UK allow this to happen in Cayman and other overseas territories? And will the US allow this to happen in Vermont and other US states?
Well, the US position is interesting, and we will see how the Biden administration navigates that in a couple of weeks and months to come. From the UK perspective, the overseas territories are of themselves members of the inclusive framework, and they have already joined the consensus statement. So, yes.
Thanks. And also further to you and your team, given the force of this apparent new arrangement, does this mean that Barbados has to renegotiate its treaties with its partners?
Well, first of all, let me say that, and I think Avi had made this point some time back, that we still don't know for sure that this would become effective immediately. There's still a number of areas to be decided upon. And then after this is dealt with at the technical level, you'll still need the political agreement and the political buy-in. So let me put that there first. Secondly, no, it would not affect our treaties in any way as it relates to how it is currently structured. What we may want to do, though, is given how we're looking to reposition ourselves as we gather as much intel as possible, we may want to, and it might be advisable for us, especially through our TNT, that's the treaty negotiation team, to take a look at our treaties as they currently stand, and to see whether we want to make any further amendments to them, so as to make ourselves more attractive via our treaties. But as it stands, no, we wouldn't have to do anything to our treaties at this point in time.
Okay, thanks. Now I have two carve-out questions, so I'll just combine them. I understand that those companies which are regulated by the FSC and central bank are carved out. Can we please confirm? And also, is there any special carve-out treatment for reinsurance business?
I am not sure as to the first question or what the person who would have posted that question means. So earlier, I believe it was both Ben and Avi that made the point that financial services is not fully agreed, but there are discussions to exempt financial services from Pillar 1 and not Pillar 2 at all. So I'm not too sure exactly what that person means by that first question. Can you repeat the second question for me, please?
Is there any carve-out or special treatment in respect of reinsurance business?
Not that I'm aware of, no.
Certainly not for Pillar 2.
No.
So as you have brought back up Pillar 1 and Pillar 2, someone has asked, can you briefly explain the difference between Pillars 1 and 2?
I mean, you have a go at Pillar 1.
You're the tax expert. I don't want to get that wrong. It's very important. It's a critical distinction. And
okay, well, Pillar 1 really is recognizing that the way that these global companies that are involved in, for example, online provision of services or sale of goods are being taxed, that the current rules really do not reflect where those profits essentially arise, where the value is. So, for example, you have Facebook, you have Amazon, etc. You have Apple, and they generate significant profits in some of the largest markets in the world, but they have no actual physical presence. And so therefore, they're not taxed. They're not subject to corporate income tax in those jurisdictions, despite the fact that they have a significant market share. They have a lot of customers in that market. And the traditional rules, they're saying, does not apply anymore. You have to find a way to be able to tax those entities based on where their customers, the jurisdictions in which their customers are based. So the whole idea is to look at these global multinationals that are operating around the world, and then you say, okay, how much of their profits are being generated in country X, how much in country Y, etc., and allocate the profits based on where those customers are based, essentially. There is a de minimis rule, which means that essentially we're too small a market to be able to benefit under Pillar 1. So we will have no real allocation of the profits of Amazon or Apple and Facebook, etc., from the customers they have in Barbados, because we're too small. So that's why we have said that we're not overly concerned about Pillar 1. Pillar 2 is really the one that impacts us. And I think I already explained how Pillar 2 works. So Pillar 1 is really an allocation of global profits of certain types of businesses, particularly the ones that operate online. And Pillar 2 is where you have a global minimum tax. And that's really designed to hit countries like us that have a low tax rate.
Okay, thanks, Ben. And so how will this impact countries who have not signed up to the global minimum tax?
Well, in our discussions with Pascal, who's the director of the OECD, he indicated that from the OECD's perspective, there will be no punitive or negative measures contemplated at this time. I don't think any of us on the call actually received that with any measure of certainty. But what I can
at this
say,
time.
Yeah, exactly. At this time.
Are the key three words.
Correct. What I would say, though, is that for the OECD traditionally has not since the first episode years ago, which former Prime Minister Arthur had to deal with. They have not been traditionally since then listing a country. They have been indicating challenges that countries may have in relation to various aspects of their regime. Enter the EU. And I think that all of us working on this team know for sure that the EU will find a way to include countries that have not joined the consensus on their on their list, on their Annex 1 or Annex 2 list, as the case may be. And more likely than not, it will be Annex 1, which is known as the blacklisting. So we can look out for that coming.
Yeah, the list of uncooperative jurisdictions.
Correct.
And that's one of the reasons, Carmel, is why there's so few countries that have not signed up to it. I mean, you say the countries standing outside of it. Well, what is the number now, Kevin? It's probably over 150.
I think now we're about 5 would be outside now. We're probably down to 5.
So
Yeah,
is
because-
Ireland still outside? Because we have a question which states Ireland, which is an EU member, has come out against the minimum, saying it will stick to its current lower rate. Do you think Ireland, like other dissenters, will cave in and ultimately comply?
I believe so. Eventually, I think that, and this is just my opinion. Avi and Ben may differ to me, and at the end of the day, we can only conjecture. But I believe that they will give in at some point in time, and we do know that there are discussions that are ongoing between OECD officials and the Irish officials, between the EU Parliament representatives and the Irish government officials as well. So I believe that we will come to a time, probably by the October meeting, where we see that Ireland is a part of.
Okay,
And because tax is just one dimension of the overall relationship the EU has with Ireland, I think it would not be difficult for them to end up with some kind of compromise where Ireland signs up to it, but there's some compensating factor for Ireland, which we don't get because we're not, we're too small for that.
Yeah, no, exactly. And I about 2 weeks ago, I think, I read an article somewhere which seemed to indicate that Ireland has struck a deal with the OECD and the EU with respect to the global minimum tax. I haven't seen anything else reported on that, and they seem to have quoted the Minister of Finance of Ireland to say that they had struck a deal and that they would be signing on.
If it is the same article I read, Ben, it wasn't conclusive. What the ministers did indicate was that it seems probable that they will be able to come to some sort of agreement. And I believe that they will.
And I agree with Avi that I mean, Ireland is playing it smart because I'm sure they will sign on, but at a price. They'll have to be compensated in some way.
Okay, thanks for that. Now on the domestic front, and I'm not sure if this question applies to just purely domestic companies, perhaps Barbadian multinationals, but the person has asked, what will be the tax position regarding those companies which operate in Barbados and sell goods and services to Barbadians? Will we have to increase these tax rates?
Well, the whole object of this approach is not targeted to those kinds of companies. It's targeted to large multinationals operating in several countries. However, equally, I think that we've all brought into the principle of not having pockets of different jurisdictions and ring fencing. So if we come up with a solution that makes sense for companies internationally, we probably will think about it seriously if extending that to domestically as well. We certainly, the amount of which domestic companies spend on R&D could certainly benefit from some increase.
And Avi and Ben, I'm not too sure we made the point earlier. If we did, then forgive me. But the rules under Pillar 2 does not necessarily mean that we have to change or get rid of our current corporate tax structure of 5.5% in bands down to 1%. Not sure if we said that before, but the two can exist simultaneously. Yeah, right.
Yeah.
Okay, thanks. So Ben, in the example you gave, does the exclusion threshold of, well, this person says US 750 million, but I think it was Euro 750 million. In revenue, you referred to a measure of the global consolidated entity or just the revenue of the Barbados entity?
It's the global consolidated entity.
Okay, great, thank you. Someone had asked, which countries are expected to benefit more from this minimum tax rate? The proposers of the tax or all the countries introducing it?
Well, it's going to be the countries that are big consumers of products which are essentially exported that they import. I mean, take a company. I don't want to slander any individual company. Take a financial technology company that has all of their IP in Ireland at the moment and sells their wares all over Europe and charges back a large amount, so they don't make any profits. They're going to be paying more tax to Europe. So basically, companies that show no profits, where they generate large amounts of revenues, will now be paying tax to those places. That means the beneficiaries are big countries where their consumers are buying products from foreign companies.
And then in terms of Pillar 2, if I take, for example, a Canadian multinational which has a Barbados subsidiary, where that subsidiary is paying an effective tax rate of 2%, assuming that Canada changes its exempt surplus rules, so that even if that company is involved in an active business in Barbados, and generally their profits when they repatriate would be exempt from Canadian tax. If Canada were to change their domestic law to reflect the globe rules, then they would tax the profits of the Barbados company to the extent that the effective rate of 2% is less than the 15% minimum tax rate. So they would impose a 13% tax on the profits of the Barbados company. I mean, that will have so in other words, Canada is the one that would benefit from these rules, unless, of course, we increase our tax rate to 15%.
Sorry, I was on mute. Thanks. And Ben, someone is asking you, so it seems like the under tax payment rule and subject to tax rule both can apply to payments from a country like the UK or US into Barbados. How are the two rules differentiated?
Well, the under tax payments rule applies, if you like, the penalty to the payer of the payment, and it can also apply to goods. So, for example, if we use the anti-hybrid rules in the UK, because we have a number of multinationals that are selling goods into the UK to a related party, and the UK can deny a deduction for the payments for the supply of those goods to the Barbados related party if the Barbados company was, say, paying zero tax. So that's why those hybrids move from Cayman to Barbados, because of the fact that they need to demonstrate to the UK that the payments received by the foreign affiliate is being taxed. Okay, so that's the rule that currently. If the UK were to apply the globe rules, then what would happen is that even though the payments are being taxed in Barbados, because that tax is less than the 15%, then the UK would deny a deduction to the payer. And the thing that many people don't realize is it doesn't just apply to payments of interest, royalties, etc. It can also apply where goods are being sold from a Barbados company to the UK company, and the UK company, of course, has to make payments for that supply. If the UK applied these rules, then they can deny a deduction to the company in the UK in respect of the payments for the goods to the Barbados company.
Okay, thanks, Ben. Sorry, you were saying something.
Yeah, so that's the on the tax payments rule. The subject to tax rule, on the other hand, is essentially saying that where you have a treaty which imposes zero withholding tax on a payment to, say, the Barbados company, where the Barbados company does not meet the requirement of meeting the minimum tax requirement, then the treaty is essentially overwritten, and the country from which the payment is being made can levy a withholding tax on those payments. So on the one hand, you have the denial of a deduction to the payer. On the other hand, the subject tax rule deals with withholding taxes.
Okay, thanks. So the questions are still growing. Would the panelists be prepared to give us another 15 minutes or so? I don't know how
I can do
budgeted to spend with us. Okay.
I can do 15 minutes.
Okay.
Yeah.
Thank you. Now this question, I think we already know the answer to, but I'm going to ask it anyway. Is the government of Barbados considering formally contesting this initiative, for example, before the UN in seeking an advisory opinion or before another legitimate forum or court?
The answer to that is no. We remember at the beginning, we stated that we are members of the inclusive framework. We participate in it. We have recognized and acknowledged that the OECD is the international standard setting body relative to these issues and principles as sanctioned by the G20. So no, we are not considering that at this point in time. I don't think we will have much of a leg to stand on, to be honest. Avi, you want to say something?
Yeah, I would only add that, you know, we're not taking anything off the table. We're looking at it closely, and if we felt there was a good case and good cause, we would do, but we would consider it. But so it's not that out of principle we're not going to do it, but I don't think there is any upside for us to do so today. Let's just repeat that. You know, it's over 150 countries have signed this. There are about 5 countries outside. What do we think we would benefit from being one of the 5? And that number 5 won't remain 5. It's going to be 3 next month. So what benefit are we going to be in being one of 3? And then what's going to happen? I remember writing to the Prime Minister on this issue a couple months ago. We're going to end up signing it. So if you're going to end up signing it, sign early. Don't be the last one having established a brand of dragging your feet and reluctant and not really interested in it. Sign early.
Yeah, I mean, I think the difference is that signing early, I agree. Signing in at 1st of July, I think we achieved the objective that we wanted to achieve, which was to ensure that the economic substance carve-out was not taken off the table. I think if all the countries had signed up on the 1st of July, there would be no opportunity to have any discussion on the economic substance carve-out. It would have been a done deal. So I think we've achieved the objectives. So I don't see any reason why we should not sign up at this point.
Thanks, Ben. So there's a question, which I think we've already covered, but I will just read it again. If the purpose is to make companies pay 15%, would we not be charged with flouting the rules by giving credits for R&D, etc.? But I think Kevin and Abby, you already pointed out that OECD is not, they view grants and credits in a different way to tax waivers, etc. Would that be correct?
Not a waiver, not a deduction, not a concession, not an exemption, a grant that is separately organized based on some separate activity.
Correct, thank you. Now, we have mentioned previously that all of our competitors in the Caribbean who fall under the OTCs, etc., have signed on. So this person had asked, for some of our Caribbean neighbors who have low or zero tax rates and offer financial services, what is the anticipated impact? So yes, they've signed on, but are they shooting themselves in the foot? Cayman, Bermuda, etc. What do you consider the impact for those low or zero tax jurisdictions in the Caribbean?
I don't think we can speak for them. I assume that they have thought through this. They have realized that it is not possible really to be outside it. They're perhaps putting their eggs in the basket of being able to defend substance. and their space on substance. I mean, we have to be, I think we've been trained and learned and taught to be responsive, because this won't end today. In 10 years' time, there'll be something new. And we will have to be always on our toes to be able to respond. And whether they can be as well, I mean, Caymans and Bermuda have proven to be responsive, very responsive jurisdictions. So I'm sure that they will be thinking about how they respond.
Thanks.
I mean, I've spoken to a number of advisors who have advised all of these jurisdictions on these matters. And I know for a fact that they were under a significant amount of pressure to sign on. So I don't think they really had a choice. What I think now is that they're going to be assessing what the impact of this would be and how they should respond.
Okay, this is more a comment than a question, but I think, Kevin, you're going to be receiving a lot of this in your feedback link. We need to seriously improve our business facilitation. When we are on a level playing field, we need to do better in this area. And I know that this is not something that has escaped, or at least Avi, for sure. We've had these discussions in relation to business facilitation from the FSC angle and the improvements that you're making there as chairman. And I know Kevin is aware of various other considerations that BIBA has raised regarding various entities that support business facilitation. So
we take this very seriously. As you know, we've gone from 15 weeks for an FSC application to 4 weeks. And our target is 4 days.
Thanks, Abby. Yes, very admirable. Kevin, did you want to say anything?
No, just to say that statement is one that I don't think you will have anyone disagreeing with at all, whether they are in government or in private sector. We certainly at the ministry we've taken it very, very seriously, and we all know of the pending changes coming to the corporate registry. And we also know of the digitization that is ongoing in the international business unit. And those are just but two of the initiatives. So it is something that we would definitely, and we have no choice, not only to pursue, but to implement, because we can discuss, we can look, but if we just discuss and research and we don't implement, we're not accomplishing anything. So we need to move past discussion and move swiftly to implementation.
Definitely. Someone has asked, under Plan B, are VAT exemptions plausible?
What do you mean by VAT?
VAT
is a domestic consumption tax.
Yeah.
So if you are selling products domestically, you'll be paying VAT. And remember, the ideas of Plan B are revenue neutral or revenue positive. The government currently gets around $1 billion from VAT. Nobody likes taxes, but if you want to reduce any tax, you need to come up with the alternative revenue.
Correct, thank you. And sorry, Ben, you were going to respond?
No, I was going to say I'm not sure where VAT would come in.
Right, okay. Someone has asked, what is the proposed logistics for tax collection and remittance to the relevant countries? But I think, again, if we are going to be looking at the 15%, it's going to be just remitted to us, basically, right? We're collecting it for ourselves, right?
But we recognize that if you have a system of grants, we recognize, this is the Kevin and Ben's point earlier, that we'd have to be very efficient at doing it. They would actually have to expect that being in Barbados meant that they weren't just eligible for grants, they got grants if they fulfilled the eligibility. So we recognize you would need a special channel to make sure that's very efficient and speedy.
I think that's an important point, because when we were looking at the Malta system and whether we should adopt the Malta system, that was one of the big drawbacks as well, was the fact that we couldn't guarantee that people get their money back on a timely basis.
Okay, someone has commented, Barbados' competitiveness is an existing impediment for economic growth for local companies first, and of course for the international community. Where exactly are we in moving the needle on the ease of doing business recommendations made by the World Bank 2 years ago now? Are we not moving too slowly to be serious global players? Now, we've already touched on business facilitation, but I know that there is actually a special government committee that is looking at the World Bank report and the doing business recommendations, which is headed up by Minister Cattle. So I don't know if Abby, you wanted to just briefly speak a little bit about that.
Yes, and I participate and chair a couple of those meetings. So enormous amount of efforts going into this. It requires two things. It requires really looking at, half the time we've got processes that are not necessary. So it's taking the process, it is deconstructing it and reconstructing it. We've just done that with the renewable energy licenses that take far too long. And we've got those down to a 4-week process plus planning. Planning has gone down from a 52-week process to a 16-week process. So that's the first thing. Those things take time. The second thing is different processes, but the same people who are used to the old processes isn't going to solve it either. There needs to be change management. And that means, making sure the officials are understanding, recognizing, and are part of this. And ultimately, we need people to be making judgments, have accountability and responsibility. And so the process is not quick. It's not snap a finger and it happens. There are multiple stakeholders involved in anything government does. It's not like a company where there's one shareholder. And so enormous amount of effort has been going on, very frustrating. I've tried to resign 3 times already. And if anything, it's because of those frustrations. So we're trying our best, really are. And it's about processes and about people.
Thanks, definitely. So I'm just trying to sift through to see. So Ben, maybe this is one you'd like to take. What kind of company?
I think.
Sorry.
We're coming to the end of our additional 15 minutes.
Yes. I was trying to sift through to find a question. I think this one would be one that you could probably take. What kind of companies can now be renewed targets for bringing their parent companies here, thereby avoiding the global rate IT businesses, management companies, perhaps? I know you have some thoughts on who and what we should target.
Is that for me?
Yes, Ben, I was giving that to you. Because,
oh, okay.
Yes.
Well, yeah, I mean, I certainly believe that we should place a lot more emphasis on entrepreneurial type businesses. Also, high net worth individuals. The welcome stamp, I think, is a good start because I've come across a number of persons who came on the welcome stamp who own businesses and are thinking of staying on and are thinking of how they can move some or all of that business to Barbados and grow it from here because they're involved in doing business internationally. So I believe that targeting high net worth individuals, targeting entrepreneurial type businesses is one of the ways to go. I also believe that insurance is going to be one of the sectors that I think can withstand the 15% global minimum tax because generally companies are established, captives, etc., not necessarily for tax minimization purposes, but to deal with the question of risk. So I believe that if we can make ourselves efficient, attractive as a place for captive insurance companies, I believe that we will continue to see that area as an area of growth. And I think the changes that the FSC have made under Avi's chairmanship, I think are important in this aspect.
Thanks, Ben. So yes, we are getting ready to wind up. Just want to get one last confirmation because there've been a couple of questions related to economic substance and the substance testing, and if they're basically still going to be relevant under this new dispensation. So Kevin, do you just want to reiterate,
Sure, Carmel. Yes, substance still remains very much in effect. And so please do not go away from this meeting thinking that you no longer have to file your substance declarations. That's not what we've said. That's not what we've indicated. Unless we have changed from our classification, and there's no indication that that will happen at this point in time, substance is still relevant. And substance even becomes even more relevant as it relates to Pillar 2, as we look to argue for an even greater formula as it relates to a substance carve-out. So substance is still very much relevant. Continue, you've been doing well with your filings, and please continue to submit your substance declarations. Thank you.
Thank you to Kevin, and I'd also like to thank Ben and Avi. I know this has been a much longer afternoon than we had planned, but this is really a very stimulating topic, one that our members have been bombarding us with questions about. So we really appreciate you taking the time out to come here today and address our membership and the wider business community in Barbados who have also joined this call. Thank you again to Renata and Invest Barbados for partnering with BIBA on this. We know that it all came together at relatively short notice. So thank you all for joining us today. And as we wind up, I don't know if the panelists want to have any final 30-second statements before we close.
Well, let me kick off and say, we know this is unsettling times. Want to assure you we're following it very closely, taking it very seriously. May not happen, taking it very seriously. Looking at working from the inside, there's no point us being one of three on the outside. Working from the inside to refine it and improve it, in particular in making sure there's sufficient space for economic substance, but also putting a lot of work and ideas into developing Plan B in case we can't make substance as important as it should be. And Plan B, we think, is possible. We think that because we're going from a lower tax to potentially a higher tax, it could create the resources, the additional resources that we can then use and plow back in to making our overall position with the addition of credits and grants very competitive to keep international business here. And we'll be forever looking for some ideas on that. We're developing some of our own. If you've got some ideas, we welcome to hear those, but be reassured that we are looking and are on top of this as much as we can be. We've had COVID, we've had hurricanes, we've had volcanoes. The world we're in today is shocks are coming. We just have to be good, to be resilient and responsive, and that's what we're trying to do.
Yeah, I would just add to that a few years ago, when we had to get rid of our preferential regimes, there was a lot of fear, a lot of concern, a lot of doubt, and we're still here. And we will continue to be still here. One of the best things about Barbados is our resourcefulness and our ability to be nimble and navigate any situation. And so let us not panic, but let us indeed work together, put our minds together, our skill sets, our experiences, and Barbados will come out the better for it. So thank you very much to BIBA and Invest Barbados, and thank you very much to all of you for joining us this afternoon.
Just to say that between now and the end of December, we will be putting our minds together to try and come up with solutions. We'll assess the impact if this global minimum tax were to go ahead. And we're working on the basis that it will go ahead, and we will come up with alternative solutions. We will be consulting with the multinationals that are here currently and are impacted. We will also be reaching out to other countries that have similar concerns to us to try to get a better deal on the economic substance carve-out. But in addition to that, and Kevin, you may want to say a quick word about it. I can't remember whether you mentioned it or not, but we will be having a retreat in early September, where we will bring in all our overseas consultants to have a brainstorming session along with the local service providers and the ministry officials, of course, to try and come up with a comprehensive plan. I mean, I don't know whether you wanted to say any more about that, Kevin, or not.
Well, just to make it clear, we have 292 attendees, and the retreat is not designed to accommodate 292 attendees.
Oh, no.
It will be in person, but as Ben indicated, yes, the consultants that the government has engaged over the last couple of years, they have all graciously consented to come to Barbados. And so we will be having a brainstorming session. Invitations have not gone out as yet, but all the usual players would be invited, ICAB and BIBA, etc. But then we also do not want to exclude the rest of you. And that's why I would have made the appeal earlier, and the email is in the chat. We want you, from PowerPoint presentations to if you have PDF books that you wanted to submit, whatever you have, please. No idea is too small or too outlandish. Please submit it, hopefully by August 23rd. That would give us enough time to go through what you've submitted, because we then want to be in a position to present a synopsis of what you've submitted to the retreat. And the retreat is carded for September 1st through to September 3rd. So that's all on that for right now, Ben. Thanks.
Okay, thanks a lot.
Thank you all. And of course, BIBA and Invest Barbados can always be channels through which you also raise questions that you would like us to direct to Kevin and his task force. Just a reminder that in the chat, we have put the email address that you're supposed to send these comments to, comments and suggestions, productdevelopment@investbarbados.org. If you can please send forward your suggestions, comments, etc. On or before August 23rd. And to answer your question about the recording for this session, it's been noted that you can view recordings of this session via the Invest Barbados and the BIBA YouTube platforms. If anyone wants to receive a recording that they wish to download, you can also email us at biba@biba.bb, and we can also send you a copy of the file. It will be rather large, so it might be in your best interest to watch it on the YouTube platforms. So thank you everyone for your time. For those of you who have to travel, please travel safely and have a good evening. Bye-bye.